Welcome to the Penga Folder podcast with your host, Nana and Emelie. They invest remotely in the UK and live in Sweden. In this podcast, they will be interviewing interesting guests that all invest in the UK property market.
Hi, and welcome to Penga Folder podcast. Today, we have the honor to have two guys that are very funny and very knowledgeable. Nigel and Ray. How is it?
Yeah, nothing like putting the pressure on, is it? It'd be funny. Let me get all my gags ready.
Hey, good morning. Thank you so much for having us. Do you know, it once came up in the best man speech at my wedding, and my mate said, Nigel's a very funny guy. And he said, not in the way that your mother said you had to be careful about, but in the amusing way. So just to clarify, folks, yeah.
Just to clarify, so that's Nigel and I'm Ray. That's it.
Yeah. There you go.
It's very nice to be here, and what an honor it is for you to have me. Thank you.
Oh, thank you. Thank you. So, guys, tell the listener, who are you? I know obviously who you guys are, but maybe people don't know, like a short background.
Yeah, well, I mean, Ray and I got together. We're just a couple of sort of oldish blokes who are young at heart still, who have lots of grumbles about the world. And, you know, we feel we should be in charge of the world because we've got the answers. No, it's one of these things. We got together to help people raise money for their property or business ventures because you saw a lot of people struggle with it. And let's face it, everyone needs money. So we did that. Me as a background, I kind of got stuck in the mentality of the go to school, do your exams, get a profession and all the rest of it. And I found myself being an accountant, which was as big a shock to me as anyone else, I think. And I've tried to suppress my entrepreneurial spirit, but found I couldn't. And then a good number of years ago, met Ray, and we kind of hit it off because we both had similar outlooks on life, both had similar sort of ideas and having done a few things, but both always wanted to try and help other people and ourselves, win-wins, and try and get more out of life. I think we always had that similar outlook on life. But Ray will now contradict everything I've said, I'm sure. But there you go. That's me.
I mean, I've been self-employed in a variety of businesses most of my life. I have imported beer. I've had a restaurant. I've had a nightclub in Glasgow. So I know all about extortion and the drugs trade and how that works. I have.
It was very successful for you, Ray, wasn't it? They were your glory years, weren't they?
I then did a law degree, not with the intention of becoming a lawyer, but I did a law degree, and then I eventually went on to become a lawyer, qualified, and worked in corporate law for a while. But my entrepreneurial spirit kept bursting forward, and I ended up working with a company called Angel's Den, which is the world's highest network of private investors. I think it still is. And seeing and helping rate about 5,000 or 6,000 pitches. I mean, people pitching for money, and sort of narrowing that down. Then we formed Property Angels Den, which was to do the same thing, to get private investors to put money into property. So this was about 2014, 2015. And then I looked for property training companies, not for me to be trained, but to find people who were looking for money, because property training companies are training people, what to do, but they needed money. So I went to see if the training was any good, and they invited me to become a speaker with them. And that's where I met Nigel. And then when they were doing or suggesting podcasting, I said to Nigel, why don't we just do one together? Because a lot of podcasts that I had listened to in sort of 2017, 2018, the ones that jumped out for me were the ones that people were just chatting rather than, the sort of set agenda. And if there were two hosts, it seemed to be better. That's what I liked. So I thought, well, we'll put it out there and, see what happens. And now we're over 116 episodes, I think. And so there we go. So we're still doing it. We're still, we've got the podcast. We're still showing people how to raise money and teaching and training and that sort of thing. And it's down to supply and demand. I mean, we're doing it because people ask,
Yeah.
So there we go.
Yeah. Me and my missus have actually learned a lot from your podcast, like
Good.
what to think about when raising money as well. So that's why I wanted to have you guys on the show. And like you mentioned, because I'm doing this show with my fiance as well, and they say like it's good when we like speak together, the dynamic, and from a women perspective and a male perspective, and yeah.
And
Yada,
I mean,
yada, yada. You know?
yeah, those. Let's think about it. Those perspectives are really very closely aligned most of the time, aren't they? Between men and women. Because no, I'm going to stop there before I get. You got to realize when you got to stop digging, haven't you? Yeah,
see me I'm biting my lip over here.
Yeah.
Okay, guys, let's jump right into it then. So, as a developer or investor seeking funds, what should you have with you when attending a meeting?
Good question.
Right.
I was going to say, Ray, just before you go into the detail, I would say never, ever go into a meeting without working out what you want to get from that meeting. So if you don't go in with a plan for the meeting, we've all sat in them, they drift around for hours, and then you walk out thinking, I think the only thing we did there was arrange another meeting. So I'd always say, have a clear intention, what you want to achieve in that meeting. But Ray, what would you say there for details?
Well, I mean, it depends who the meeting is with. So let's make the assumption that the meeting is with an investor, a private investor or a lender. If it's with a bank, the bank have a very defined process. So they'll just want to meet you and they'll want to control how the meeting goes by asking you for all the information, and they'll tell you what to bring. But if you've got a meeting with a private investor, then usually they will already have seen some information. So they should already have seen a one-page summary, for example. They would have liked the summary, then they would have asked for more information, and then they would have asked for financial appraisal. So they should have all these things already. When they're inviting you to a meeting, the meeting is to see you. The meeting is to see, well, is this person credible? Do they know what they're doing? Can we trust them? Because they'll have all the other information. So I think you want to define what the meeting is. So if you say, well, you've called me in for a meeting, is there anything I need to bring? And they'll tell you. They'll just say, yeah, no, it's fine. Just bring yourself. We just want to meet you. And then what they'll do usually is they'll ask you a bit about yourself, your background, and all the time they're looking for credibility. Have you done this before? If you haven't done it before, it's going to be difficult to get funding, which is why we say you need to partner up with somebody who has the experience you do not have. But they're really wanting to see you. They just want to have a chat. Just, right, hi, tell us a bit about yourself. Okay. And then if they like that, then they'll go into the details that you've sent them and say, right, okay, now you've said that you're going to make a margin of 23%. What happens if prices go up? What happens? They're just going to start pushing you and looking for what ifs just to see if you've covered everything off. That's really it. That's certainly my experience most of the time with most of the meetings. So I hope that helps.
Yeah, great answer, both of you. And what type of security do you usually tend to require when lending out money or investing?
I mean, I just made a couple of quick notes, and for me, it's a really interesting one because people always look for a formula or something, but what you've got to appreciate is every situation may be slightly different, and I would say whatever is sufficient. So you've got to look at this and don't pile in with everything, because I've spoken to a number of people, and Ray will have spoken to far more, where they offered 15% and the person was kind of bowled over and actually backed off because they thought that was too much, and 5% would have done the job. So, in terms of that being the return, then the security beneath it, they'd say, and I'll put it on this property and that property and this and my firstborn and my house and the dog. Sometimes it's too much. So ask the question, what are you thinking? What sort of security do you typically use? What sort of security would make you feel comfortable with this?
A good question.
And have a chat about it.
Sorry to cut across, Nigel. A good question is to say, Mr. Investor, what's important to you in investing? Because they'll tell you. Because if what's important to an investor is the biggest margin you can possibly get, then they're less worried about the security. If the thing for them is, I mean, I have one guy and he won't touch anything unless he can get a first charge. If he doesn't get a first charge, not interested. And then I've got others that take nothing. So, personal guarantee will do fine. Do you want it backed up with assets? Do you want an asset list? No, it's okay. Just get them to sign my guarantee form. Because to some people, £10,000 investment is, they're going to watch it like a hawk. And then we've got others that put £1 million in and then they don't really care. So, it's Mr. Investor, what's important to you? And that will give you an indication. And then say, they will bring it up. I mean, we have a formula we talk about called the CREST formula, it's CREST, and the S of CREST is security. So they will usually bring it up. Now, if it's property, then the security can be a charge over the building, depending on whether the investor is the primary lender or the secondary lender or the mezzanine lender or wherever they are in the funding stack, then they'll be entitled. So the person putting most of the money in would quite rightly want a first charge if possible. Now, if that doesn't cover it, they may say, do you have any other unencumbered property? So property that doesn't have any charges on it, or a property that's got a first charge, but there's quite a lot of equity in it and it could support a second charge. So just ask the investor, say, what sort of security you're looking for. Now, if you're raising money for a business, it's usually the shares in the business. That's what they're buying. So they're investing in the business and they're getting shares for that. And then the shares may go up, they may go down. And in the UK, we have a thing called Enterprise Investment Scheme. So for some investors, the security is that the company they're lending to has been selected, pre-qualified by the Revenue and Customs as a company that's eligible for Enterprise Investment Scheme investments. And that gives them a certain comfort. So security can come in different forms.
Yeah. If just thinking about it, if when you're talking to an investor and the investor's fairly blasé about it and you sort of go, really? And they say, well, I know where you live and you have to sleep sometime, I would look for a different investor.
Good answer of both of you. Again, I'm loving this. So what are the minimum length you should give when you suggest this term then with the investor?
Yeah, minimum terms. Again, I would always say, Ray said it beautifully in the last answer, in terms of ask a question. And whenever you're sort of wondering what the person should do, don't both of you try and mind read. Just ask a few simple questions. And what you'll probably find is if the conversation flows, then it will be reasonably easy to work out what each party values. And at that point, you will be able to sort of go, bring the conversation around to, okay, so are you a 12-month person? Are you a 10-year person? If you like 12 months, do you know someone that likes 10? Because depending on where you are on that spectrum, the deal is either going to work or you're going to be miles apart. And Ray, you've got a lot of people who like very short-term lending compared to a standard mortgage of 20 years.
Yeah.
That's what they're after, isn't it?
I mean, the shortest we've done is a week. Somebody needed money for a week. It was because I think it was a VAT. They were getting a substantial amount of VAT back from the revenue, but it had been delayed over some admin technicality, and they had to complete on a property purchase, and they needed, I think it was about £100,000, literally for a week. So that's the shortest we've ever done. Average would be 6 to 12 months for short-term lending. And then after that, we've had recently a number of investors who've put money in short-term, but have been prepared to convert it to 3 years a term. Because in the turmoil that we have at the moment, people are looking for stability. So the developers are looking for stability, as in, could I use the money for a bit longer? Probably because developers who've got a bit of experience know that things always take longer than you imagine. I mean, I was talking to one yesterday, and he's building houses, and he's got some of the houses pre-sold, but the local council had decided that the name he'd chosen for his development, it was a new street, they built a new road, they had new houses, a new street, and they had to apply to the council for naming. And he paid his fee, which is about £450, £500. You pay a fee, and then the council tell you that, yes, you can have that name, or no, you can't have that name. And they'd said to him, yes, you have the name. And then they turned around and said, no, you can't have the name. It's been voted against, so you have to reapply. Now, that might sound, well, that's a bit of a nuisance, but it has a knock-on effect. And the knock-on effect is that without the name, they didn't get specific numbers to allow the utility company to connect the power. And that actually added about 3 months to the project, just that one thing. So, you never know where these things are going to come from that's going to delay things. Another one just last week, a deal had been done. The money was to be transferred on Wednesday. And on Wednesday morning, the solicitor on his way to work got run over and ended up in hospital. And the money is now due to be transferred today. Now, that prevented something happening on Friday that was very important, because they thought, well, it's coming on a Wednesday. We've got 2 days. So if there's a delay, we've still got 2 days. I mean, no one could account for that, for a lawyer getting, run over in the street.
I was going to say, as much as many people sometimes wish it would happen, no, come on, we all love solicitors. Yeah, they're all fabulous people. I mean,
we ended up, the people on the other side sent us, it made the news, the local news. They blocked off the street, and it led to traffic disruption and things like that. And it made the news. So another one development was all going nicely. And then recently there's been supply issues, commodities and supply issues. And they were waiting on a delivery of 18,000 bricks. And the bricks arrived, but they were the wrong color. They'd already built half, so they had this wall that was halfway up. And then the bricks that arrived with the color. So they couldn't, put them on top. So what they had to do was then demolish the wall that they'd already built and use all the new bricks to create that side-facing wall, and then take the older bricks, which now were obviously covered in hard cement, and then there was an additional amount of work. Do you see what I mean? So those are things that when you add in contingencies for things going wrong or delays, most people would add in, if people come to us and say, we need money for 12 months, we say, well, I think you should borrow it for 15 or 18. And they're always, no, it'll be fine. Borrow it for 18, seriously. And if you don't need it for 18 and you can pay back earlier, that's fine. We'll make sure that you don't get penalized for paying back early. In virtually every circumstance, it's not every circumstance. It's about 50-50, I would say, in terms of going over the limit versus the ones that complete on time. Because, things happen.
Yeah.
Things.
COVID happens.
Well, yeah.
Shortage happens.
Yeah, exactly.
I totally agree with you. So what questions should a borrower be able to answer?
Good question. And the simple answer is all of them. But here's the thing. It's funny, Ray and I were talking about this just the other day on our podcast, and it's very tempting to try and give an answer to everything there and then. But you've got to appreciate what you do know the answer to and what you are not certain about the answer, at the moment, and separate the two and have a clear sort of point in your head where you say, right, I really don't know that. So just say, look, this is a great question. Can I just ask why you're asking that? Because at the moment, I don't think I've got the answer for you, but I will get the answer to you by whenever. And then make damn sure that you do give the answer to that. If you are doing something and, if you're under pressure doing the pitch, or you're feeling under pressure, sometimes just have a little piece of paper, a little pad and a pen in your hand, and just say, I'm just going to make a note of that, because that's a great question. So, and I'll put a date on, yes, and I'll come back to you with that. I think everyone appreciates that kind of response. We've all seen it on the TV with politicians when they try and give an answer off the top of their head. And what happens, it comes back to bite them when the very next interview, the next day said, well, you said yesterday X, Y, and Z, and it's now A, B, C. So don't get caught out. Answer everything. You should be able to answer the vast majority there and then, but just say, look, that's a great question. Don't know at the moment. I'll get the answer to you by tomorrow. Is that all right? And if that's the case, then that's the best way to do it. Certainly, Ray, you don't want to start making up numbers, because we've all seen Dragon's Den and Shark Tank where they try it. Not normally that successful, though, is it? It's great TV, especially as it zooms in on the beads of sweat running down their face. But no, you don't want to go down that route.
Do you have anything to add, Ray, what Nigel said?
What was the question again? No, I mean, I'm kidding, but I do mean that as sometimes you need to ask someone to restate the question a different way, because you might think, well, do you mean this or do you mean that? And if it's one of those questions that's a bit ambiguous, it's over. Go back to the potential investor and just say, well, I'm not quite sure what you mean. The one thing to always bear in mind is this is a meeting of equals. You're not there with a begging bowl. You're not there desperate for their money. You might be desperate for their money, but you should not come across as desperate. You have to come across that, they are looking to invest their money. They're getting something out of this. They have the money, but not the time or the knowledge to do this. And you have the time and the knowledge to do it. And you're going to give them a fantastic return on their money, much better than they're going to get in any bank or anything like that. The one thing is, at the moment, there's a lot of cash around, an awful lot of money around, but there's not a lot of deals. I was talking to a guy just yesterday. He said, I've got £800,000 in the bank and I've got nothing to spend it on. There's no deals out there. I can't get any deals. Now, about an hour later, I phoned him up with one that he's going to be looking at today. In fact, that reminds me, I have to do an introduction to someone on that. But that's a common theme that's been coming through now. We're seeing people saying, well, I've got the cash, but there doesn't seem to be anything around. There are supply chain issues. There seems to be a manpower shortage. Are we still allowed to use the word manpower? Anyway, you know what I mean. The majority of builders are men, so it's not person power. It's tradesmen, tradespeople.
Yeah.
And so that's leading to challenges in getting things done. Nigel knows someone, for example, who works for a consortium, and they put money into a project and it's gone a bit over because of commodities and things. So that means that they are unable to look at any other deals because they're bogged down in trying to fix the one that they've got. Now, if you're going to get a return of 10% or whatever it is, you're expecting that return in a period of time like 10 months, 12 months, 14 months. If that suddenly stretches out even further, there's also the opportunity cost that you're losing out on, because people may come to you with other deals, and if you're bogged down, it's a challenge. So it is a meeting of equals. The money is as important as the deal, but right now, the deals, good deals and good teams who can deliver, I think, are in short supply, not money.
Yeah. Great answer, both of you as well. How important is the return compared to the risk?
It depends. And it's like anything. If you're tiny, the molehill looks like a mountain. And if you're a giant, the mountain looks like a molehill. And it kind of depends where you are. But I'll give you an example here of different perspectives with regard to return and risk. So someone that has £85,000 in the bank and who is getting 1% return a year, they may look at that and say, okay, I know that £85,000 is guaranteed. It's not going to go away. The risk is zero, and I'm going to get 1%. And I'm happy with 1% because my living costs are fine. Another person might look at that and just say, well, who knows what might happen? And 85,000 only getting 1%, this is crazy. And, surely you can trade a bit of risk and get a better return. And even offering a 2%, you've suddenly had a 100% increase in the return. And maybe the risk is on a property instead of the bank, and the property is at 50% loan to value. You've got to start thinking, okay, what is this combination that people like? And for some people, they want to return a 15%, and the risk, they can have it relatively high. But that relatively high is only relative to those people that like zero risk. To him, he might be thinking, actually, this is still pretty risk-free as far as I'm concerned, because I've got 20 of these investments, and I work out that 15 will be all right, 3 will be superstars, and 2 will completely bomb. but my portfolio of risk there is kind of pretty low. Look at any one individually and you'd think it was crazy. But it's this weird sort of mix from where the person is and what they're doing. If you've got £1 million and you lent someone 10,000 and it was quite risky is what? It's only a perspective. When you've got £1 million, 10,000 is no risk at all, is it? It's not going to affect you. But if you only have £10,001, then putting 10,000, virtually all your eggs in one basket, could be seen as very risky. So it just depends where you are. And this comes back to what Ray was saying. Ask the questions of the investor. What would they typically feel is a good return? And, how risk averse or risk sort of aware are they, and where do they want to be? Because it literally is different for every single person out there. And you can't really make it hard or fast rule. All you can do is try and tease out where you think they sit so that you can put it together. And then you make suggestions and say, well, would you be happy with this sort of return and this sort of security on a deal? And does that fit within your risk profile? Does that fit within the returns that you're after? Or should we just nip down to the casino and stick it on? What are the numbers? What do you reckon? Come on, you get free drinks down at the casino. Who knows? It's why we're all different, and it's why it's such great fun.
A couple of things about risk. So first of all, about teams and their risk profile. And then secondly, about an investor I was talking to a few days ago and about his attitude to risk. So many years ago when I was with Angel's Den, or I used to work with Entrepreneurial Spark or some of the incubator startups, we'd see startups and there'd be 2 or 3 people on the team. I would ask them all to do a risk profile analysis, which it was an online thing. I haven't actually found it again. It used to be on a website called sherlawscoaching.com, but it's not there anymore. And I haven't looked at it recently because I don't work with startups a lot of the time now. But it gave you a score of between 1 and 10. So 10 being massively risky, guy would get some money, walk into casinos, versus 1, which was take no risk at all, virtually not even leave the house, And most people were in the range of sort of 3 to 7. Most people would be between 3 and 7. And the ideal team for a startup is you had one who was a reasonably high score, 6 or 7, and another one who was a reasonably low score, 3 or 4. That was a good team. Good balance there. What you didn't want is 3 founders who were all at 7, because that's just a recipe for disaster. But you also didn't want 3 founders that were all at 3, because we would get nothing done. So most of the best teams I've seen have had mixed profiles like that. Now, on to the guy I was talking to the other day about risk, because he was doing something, or he was proposing to do something that seemed to me to be, from my point of view, quite risky. Now, I'm entrepreneurial, so I would say I'm probably a 6 or a 7 when it comes to things. Maybe my wife would say I'm an 8 or a 9. But anyway, I just, that's a bit much. And he said, well, like most investors, he balances out. He doesn't just put money into property or just into something. And he said, in the last 3 years, I've had 40% return on gold. I've had a 1,608% return on cryptocurrency. I've had a 12% return on property, and I've had a 5% return on the stock market. So he says, as far as he was concerned, he was balancing everything out. And I said, wow, why wouldn't you buy more gold or go into more cryptocurrency or something like that? And he said, well, because I only use a percentage of the money. I'm not going to put it all in. And he says, and I also have some cash. You've got to have a bit of cash. So he's also got a bit of commercial property. It was a commercial property deal he was looking at that seemed to me to be, I just thought a little bit risky. I wouldn't have put money into it. And one of the things that we do when people come to us to look at using funding for something, me and the team, we always say, well, is this something we would invest in ourselves? And if it is, we'll promote it. We will put it to our investors. But if not, then we'll say, no, it's, you need to go away and work on something. And we have a formula. And basically, the formula we have invites a score. So I have a checklist, and on that checklist, there are about 20 items, and each item has a score from sort of 1 to 10. So if a deal comes in, I'll have a look at it and I'll say, right, I think that's just without too much thinking about it. We kind of adopt an approach. There's a great book by Malcolm Gladwell called Blink. It's called The Art of Thinking Without Thinking. So when we look at something, I don't try and analyze it to the nth degree. I literally take 20 minutes and go, right, okay, is it a limited company? Yes, it is. Is there a decent team behind it? Yes, it is. Have they done something before? Yes, they have. Is the return offered, can the deal support the return? Yes, it can. Have they considered all the exits? How many exits have they got? Are they selling? Are they renting? Are they, and the more they've considered, the higher the score they get. Once I've done all that and add it up, if it gets 95 or more, we go ahead with it. If it doesn't, we look at the areas where it falls short and then go back. So it might be that, your team's not credible enough. You don't have enough experience. You're borrowing too much. It's above a certain percentage level. You're not putting enough of your own money in, or whatever it happens to be. So it's a combination of logic and emotion, but mostly because it's money, it needs to be mostly logical. Does it stack up? Does the financial appraisal stack up? Yes or no on a first pass? Because there's a tendency that startups and some developers tend to have is if they get emotionally attached to something, they adjust the figures to suit. They'll put in and say, well, I've been told it's £1,700 a square foot, or sorry, a 1,700 square meter, which seems to me to be a bit high. I'm going to knock that down to 1,500. Now it works. And the contingency at 5%, it's a bit much. I'll knock it down to 3. Things like that. Now it works. And that's the wrong approach to take. It either stacks up or it doesn't stack up. So when there's a large amount of money involved, although people can be risky, they'll usually run it past someone who does financial appraisals and say, right, run that past. There's a bit of software that you can get access to, which allows you to do financial appraisals. And you just put in the square foot area, you put in, what you want to do, if you want to sell it, et cetera, all that, what you're buying it for, what's your property taxes, what's your professional fees. You just pump all that in, the figures and it will tell you if it works or not. And the figure at the end is either in green or it's in red. And if it's in red, you don't do it. Simple as that. So whilst people, a lot of the investors have accountants and lawyers, and they'll say, well, I want to do this. Is there any reason why I shouldn't do it? And the lawyer or accountant will come back and say, no, it looks quite good. Or, and there's one guy in particular, his accountant usually always comes back, tells him not to do it, and he does it anyway every single time.
And how has it gone?
And I said to him once, well, why are you taking his advice if you're not listening to it? And he went, well, he's the accountant. He said, I'm the one that takes the risks, not him. I pay him anyway. He gets paid anyway at the end of the month, no matter what happens. So to make sure I've got to keep paying him, I've got to keep taking risks.
That is true. Just one little thing in there. I've done some stuff where we weren't too sure if we had enough sort of strength in the team, enough experience. And you kind of look at the return, you go, well, I could get 12% if I did this, but if I added this person to the team, it probably enhances the strength of the team, probably reduces the risk of problems happening, but the return might only be 10.5% if that person comes in, adding that cost. And you might sort of say to someone, look, we can do this, but it hasn't got this person. What's your opinion on this person? Do you think it would be of value? Would you accept a slightly lower? And you could give people options and they'd say, no, go full ahead. Let's see if let's gamble on the 12%. Or some would say, no, that's a sensible appointment. 10.5 still beats my criteria. The risk and return works for me. So there could be ways of adjusting both of those to make it work.
Yeah. Good answer, both of you. Again.
Well, Ray, we're on a roll. We're on a roll,
Ray.
Ray.
On a roll.
Hey, this is where the wheels come off.
So, following what you say, Ray, regarding the different asset classes, have you seen that people are more towards like crypto and meme stocks and etc., and like discouraging property now during this COVID period, or are people still want to invest in property?
I think keep investing in property until a taxi driver tells you. Once a taxi driver tells you to invest in property, get out. That's a golden rule. I think it was J.P. Morgan that said he, back in sort of 1900s, late 1890s, early 1900s, J.P. Morgan, big financier in America. And he said, when the shoe shine boy started giving me stock tips, I pulled my money out. When the shoe shine boy started giving me stock tips, I pulled my money out. And he said that saved him on many occasions. Because, just because. So at the moment, if people are fearful of property, which they're not, incidentally, certainly not in the UK. In the UK, we've seen a boom, which no one was expecting. They think it was all driven by the fact that the Chancellor in the UK reduced stamp duty, but that had the effect of actually driving up prices because more people were now in the market. The UK also has the advantage of a stable economy. So from all around the world, people look at the United Kingdom and it's got a stable government. It has a government that's never, ever defaulted on a debt, ever. And it's a good place basically to buy and store money in assets. And there's been a lot, certainly people I've spoken to in Liverpool, Manchester, and in London, there's a lot of money that's coming from Hong Kong. So people in Hong Kong are fearful of what's going to happen there. They want to get their cash out while they can, and they want it to be in bricks and mortar, safe as houses, all that carry on. It's not sitting in UK banks because in 2008, we had a run on the Northern Rock Bank when people were queuing outside. And then also people are afraid that it happened in Cyprus where the government just turned around and said, right, you've got savings, but we're taking 20% because we're in a pickle. Thanks very much. Just like that. And in UK banks, your money is secured up to 85,000, unless you put it into a national savings bank. If you put it in the national savings bank, it's secure up to 1 million. So some people do that. Generally, though, it's seen to be safe to put money into property. So cryptocurrencies and gold and things like that are asides. Just about every investor I know has a valuable painting. They have valuable watches. They've got a valuable car. They've got, valuable artifacts. They've got some crypto. They've got low-cost index funds. They've got insurance policies, things like that. Generally, it's wise to spread the risk, if you like. And as they get older and as they develop more wealth, they start looking for different places to put their money. And at the moment, impact investing is quite high on the list. So in other words, people are saying, well, I can invest in affordable housing, for example. I'm not going to get a massive return, but I'm still going to get a yield of 3 to 5%. But if I put it into commercial, I might get a 10% yield. Or if I put it into ordinary residential, I might get an 8 to 10% yield. So they're prepared to put it into different things for lower yields just because they can and because it makes them feel good. So, yeah, but in terms of crypto, most people, once they've got the hang of it and know what it's about, tend to put in, I know guys that are multimillionaires, but they wouldn't have any more than about £100,000 in it, something like that, because they just want to know how it works. They don't necessarily see us making money from it. But some of them are still very skeptical about blockchain and wallets being secure and all this kind of carry on. And they will have Bitcoin and they'll have Ethereum. And some of them have invested in others that we don't even know about, Dogecoin or Rally or something like that. I know a lawyer, for example, he bought a thing called Gary Coin. Yeah. He put $250 into Gary Coin earlier this year, and it's sitting at 13,500 now. So because the guy behind it's promoting it, it's run by a company called Rally.io. I'm not promoting it. I have some because I put in, I put in $50 just to sort of, to see what it was about. And it's purely because of interest. I just want to, I want to be in it so that if anybody asks me about it, at least I have, I can at least say, well, I know how to set it up and I know what it's gone up and etc. I have some gold, not much, but I have some, gold. I joined a club a few years back, and it basically all goes to my children. They're sitting there with these, and it's, you can buy them in packets of a gram. They're worth about between 40 and 50 British pounds. Just things like that. So you'll find that most people will, of a certain age, investors that are sort of 60, 65 and above don't seem to have much interest in cryptocurrency or anything like that. They're not interested. But younger investors, and when I say younger, I mean certainly 50s, 40s, they all have something, but not huge amounts.
Yeah. Okay. It's a weird one. I've put some money into crypto. I've got 21 different types of crypto in this wallet here, and it's up and down like a sash window, to be quite honest. But it's great.
I'm glad you used that as to describe up and down and not the other.
Yeah, I was thinking of something else, but you probably knew where I was going, but I got nervous there. But yeah, it's great fun to watch. But here's the weird thing. In the UK, you have something called IFAs, Independent Financial Advisors. And for years, I don't know if it's changed, but for years, they classed property investing as the highest type of risk, and they therefore never, ever advised anyone to do it.
Yeah.
And you look at it and you think that is the most ridiculous thing ever, because it was only if, when you do, like you were talking about, Ray, the risk profile, what's your attitude to risk? It was only if you went off the scale, might they sort of tentatively maybe think about looking at, wondering if you might want to have a look at a house. And yet you look at the thing in the UK, we're an island, there's increasing population, there's limitations on how many houses you can build and the actual physical ability to build these houses. So that at the moment, the demand is always outstripping the supply, which means fundamental economics, prices go up. So why do IFAs not get into the properties? It's a weird one. So we're in this crazy thing where everyone who looks at IFAs and goes, why am I taking advice from someone who is just above broke, about how to invest in wealth? It's crazy. And I know a number of people who have gone into the bank and they're at the counter, and the person looks at the account and says, oh, you've got some money. Would you like me to have a chat with you about how to invest it? And they kind of look at the person thinking they're about 23, and I bet they've got student debt and no money. Remind me, why would I like to have a chat with you about how to invest money when you don't have any or the experience? So it is dependent on the age and the attitude of the person. But yeah, it's it's a funny one. Is this? It's a funny one. We get such contradictory things. Buy gold, don't buy gold. Yeah. Buy crypto, don't buy crypto. You're a nutter if you buy crypto. And your head's in a spin. And sometimes you just got to take a step back. And as Ray again said earlier, take a logical approach to it and think, okay, what's my attitude to risk? What sort of return would I be happy with? If I get 8% on average for 10 years, I've doubled my money. So you've got to just take these steps back and go, what's my time horizon? If you're 95, you're probably not going to get, some 25-year mortgages. It's unlikely. But if you're much, younger, then you look at your time horizon, look at an average return, and then think, what's the risk in that? And that's when you can start making some better decisions. But nobody teaches it at school that I'm aware of. My kids certainly haven't come back with it. No. The only thing they teach them at school is, what do you want to be? And the answer from every kid is a YouTuber at the moment. And you sort of think, at which point the teachers sort of dismiss that. And you're left stuck with I don't know what they're going to do. And here's the weird thing. I still don't know what I really want to do. And so I'm looking back at my kids thinking, I can't give you any advice on this because I haven't worked it out myself yet. And I'll give you an example. My form teacher, when I was 16, appeared in the news of the world because whenever it was games, I love golf. It's Ray's favorite sport, although he's in denial. But I used to, he'd call the register and say, what are you going to do for games? And I would say golf. The reason was there was a little golf course near where I lived, and me and a mate would go. We'd hit a couple of shots and then go play snooker. Obviously, no, we did play golf, honestly. But whenever I mentioned golf, this teacher would say, golf, what are you wasting your time at? I'd say, it's a good sport. And he'd say, it's only for people when they're retired and near death. And I thought, well, that's a bit harsh. Anyway, he appeared in the news of the world, a big Sunday newspaper, centre spread. I was the guy who told Colin Montgomery he should give up golf because he went to my school as well. And this same teacher told Colin Montgomery, golf, what a waste of time. You'll never be any good at that. So
Colin Montgomery was one of Scotland's finest golfers. Did he win an Open?
No, he never won a major, but he won the Tour, the Order of Merit, I think something like 9 times.
Yeah, millions of dollars anyway.
Ryder Cup, winning captain, Ryder Cup winning player, and he's won on the senior tour, he's won loads of majors. So yeah, the multi-million-pound Colin Montgomery thankfully didn't take the advice of my school teacher. So there we go. Sometimes the advice we get from the people that we think are in the institutions are not necessarily the things that we need to do. So there you go.
Just a story about crypto. In, I think it was summer or spring 2017, I attended an event hosted, no, it wasn't hosted. One of the presenters was a guy called Dr. Garrett Heilman. Now, Dr. Garrett Heilman is sort of professor of cryptocurrency at Crypto University Oxford or Crypto House Oxford or something like that.
On the planet crypto.
Yeah, anyway. And he came along. He's sort of American guy, lives in the UK. I get mixed up, Oxford or Cambridge. It was one of the two. It might have been Oxford Polytechnic. I'm not quite sure. But anyway, he gave a very good presentation on crypto for about an hour, saying where it came from, how it started. He showed in layman's terms how the blockchain worked. And it was a real eye-opener to me because up until that point, it was just, I had no clue. And he said, here's how you open a wallet. Here's how you do all these things. And immediately I went and opened a wallet and I bought a small amount of Bitcoin and a small amount of Ethereum. When I say a small amount, I think it was £200 or something. And over the course of the next few months, I ignored it. I didn't look at it. I had a thing called Coinbase where you could look at it, but I hadn't opened the app in months. And my 200 was now 900 or something. And I thought, okay, well, I'm going to take my 200 out and leave it in. And now so I learned how to take it out and just left it running. And then, of course, it started, I think then it was about £15,000, which it's at 28,000 now or something, pounds sterling.
Wow.
So it was at 15,000 or something. And I just kind of left it. And then I was doing a presentation in Leeds, actually. It was a property event, but I was on the stage and somebody asked me a question about crypto. Did I know anything about Bitcoin? And I said, and this was true, I said, I got my first Bitcoin for $1. And I have it here in my pocket. And I took it out. I was searching for it there while you were talking. But it's a big circular coin. I mean, I'll go and get it in a minute. When Nigel starts talking, I'll disappear and I'll bring it back so you can see what it looks like. But whenever you see a representation of Bitcoin, they always show you this coin with a bead on it.
Yeah.
Yeah. And I had one of those coins. It's quite big, right? It's chunky enough. And I said, well, actually, I have one here on the stage, and I held it up. And I said, can anyone in the audience tell me what a one Bitcoin is worth right now? And someone said $17,000, whatever it was, 17,200 and something. And I was like, right, okay. So to tell you what I'll do, I'll tell you about Bitcoin and how it works for 5 minutes, which I did. And if anybody wants to buy this Bitcoin, I'll sell it here today. And people started bidding. They said, I'll give you £200 for it. I'll give you £300 for it. I'll give you £400 for it. Now, one half of the room were kind of giggling, right? And I was looking at them as if to say, shut up. and the other lot were getting in a frenzy to try and get this Bitcoin. Anyway, I said, look, I'm going to stop it at £500, right? So who's first to bid? And before I even said it, someone went, I'll have it, £500. £500, right, fine, fantastic. I said, you absolutely sure you want to pay £500 for this Bitcoin? Yes. How are you going to pay me? I'll transfer the money right now, all the rest of it. I said, right, okay. So thank you for that. But I did not mean to, make you feel less than or try and humiliate you or anything like that. But this is why you need to have knowledge. You need to get knowledge about how things work and not just take it from me because I'm standing on a stage here telling you in 5 minutes. And I said they ought to take time out and go and see a talk by this guy, Garrett Heilman. I think you can see it online now. You'll be able to see it on YouTube probably. He's certainly got a website. I said, you ought to, because this Bitcoin, I'm correct. I did buy this for $1, but you can also buy it for $1 because it is a representation. If you want an actual Bitcoin, you have to have a wallet. You have to purchase it through the blockchain. You purchase it through Coinbase or someone like that. And you see them go, okay. And I said, so, it's a sort of wake-up call that you just need to be aware. Now, about a couple of weeks later, I was with an investor that I met. I was at his house and I was talking to him. And he asked me if I knew anything about Bitcoin. So I did the same thing. I said, well, actually, I have one here. I said, Bitcoin at the moment. And I went onto Coinbase and I said, look, it's at 17,000 each. And he's like, 17,000 for one. And he didn't understand it. And I said, yeah, and I have one here. And I took out the coin. And he's like, wow, that's fantastic. And I said, but I'm going to give it to you. And I gave it to him. And he's like, you just I can't believe this. I can't believe this. And then I told him, and I said, well, actually, it's not worth anything. Look, you can go to eBay and you can buy one there. But he then said, well, I've got something for teaching me, for educating me. And he went away and he brought back this. It is a gold coin. It's called an angel coin. Very old, right? It's an angel coin. Now, it's not in particularly good condition. If it was in really good condition, it would probably be worth about £1,500 or something. Oh, wow. But this one might be worth, I don't know, £1,200. So it's called an angel coin, which was the precursor to gold sovereigns. Now that, in King Henry VIII's time, that was a sailor's salary for a month. That was a sailor's salary. And the reason this guy had them is he had put a lot of money in the early 80s, raising the Mary Rose, the ship that was Henry VIII's ship. Yeah. And it left whatever harbour it was. It was launched, but it was top heavy and it just collapsed into the harbour and hundreds of people died. But on board that ship was a lot of angel coins. So when he sponsored the Mary Rose to be brought up and recovered and all the rest of it, they gave him a number of these. I don't know how many, but he had quite a few anyway. That was kind of his share of the booty, shall we say. So he gave me one for teaching him about Bitcoin. So there you go. And while Nigel's talking next, because he'll
I just want to bring the Bitcoin. Yeah, I just want to add into that. Ray, what a fantastic story about how to raise money by bringing in a 400 or 500-year-old wooden ship that had been raised off the seabed. Perfect, my good friend. But what you don't understand is how much Ray used to love doing that Bitcoin thing. I'd see him on stage, and honestly, you'd have people coming out of the chairs trying to rip it out of his hands, going, he's giving away a Bitcoin for only £500. And it is so true, isn't it? You can see how people fall for scams and all sorts of things when they just let that emotion sort of, rule their head and their heart and everything else, and they go in for it. But this is where the difference comes when you're pitching to seasoned investors, because if they don't understand it, so the vast majority, if you're talking about crypto, they just go, look, I don't understand it, so I'm not going to do anything at the moment till I do. Yeah. Whereas a lot of other people jump in far too quick. But there it is with the B with the double line on it. And he would love to do that. And he would say to me before, when we were doing different stages or whatever, talking to people, he'd say, I'm going to do the Bitcoin thing. I'm going to do the Bitcoin thing. Stuff. I think
buy them on eBay. They come in a little bag like this.
I think you gave me one. You gave me one.
$1. They're $1. I bought about 50 of them just to give away.
Yeah. I think you gave me one and I tried it. And people just... They're almost bowing down. You have a Bitcoin? Whoa.
I think I can trick my mom with that joke.
Also, I found that's one of the cards with the gold in it. I don't know if you can see that there. A little gram of gold. So my kids have a couple of those. It was beside the Bitcoin.
Well, thank you guys, Ray and Nigel. Been great having this conversation with you, and I'm sure we will learn even more from you guys in the next episode. Thank you so much, and remember, don't be stressed, invest.